Hello, everyone. This is Ocean. Today we will talk about current ratio, quick ratio and cash ratio. Those measure a company's ability to generate enough cash to pay off debts due within 1 year. But before going into them, let's understand why we need to know a company liquidity condition before investing. What does a company normally do? If it has difficulties to fulfill interest payment, bond dividends, suppliers' invoices, and staff salaries, it can take more loans. This will reduce next year's earnings. Raise funds by issuing more shares. Existing investors are forced to buy more shares, otherwise their ownership percentage will be diluted. Default. This can have more negative impacts on the market and investors' confidence. All the three scenarios above will affect the company's share price and harm shareholders' interest. To avoid it, we have to ensure the company we are going to invest least likely has this issue. What is current ratio? The current ratio is the proportion of the amount of current assets, divided by the amount of current liabilities. Current assets, on a company's balance sheet, represent the value of all assets, that can reasonably be converted into cash, within 1 year. Current liabilities, are the company's debts or obligations, on its balance sheet, that are due, within 1 year. What is quick ratio? The quick ratio, also known as the acid test ratio, is the proportion of only the most liquid current assets, to the amount of current liabilities. It is a more conservative measure of liquidity, as it includes only assets that can be converted to cash within 90 days or less. Quick ratio equals cash and cash equivalents, plus short-term investments, plus accounts receivables, divided by current liabilities. It's recommended a quick ratio to be at least 1, indicating that for every dollar you have in liabilities, you have $1 in assets. If comparing the quick ratio to other companies, only compare to businesses in the same industry. Here is a summary. A few things to highlight. Since the current ratio includes inventory, it will be high for companies that are heavily involved in selling inventory. For example, in the retail industry, a store might stock up on merchandise leading up to the holidays, boosting its current ratio. However, when the season is over, the current ratio would come down substantially. As a result, the current ratio would fluctuate throughout the year for retailers and similar types of companies. On the other hand, removing inventory might not reflect an accurate picture of liquidity for some industries. For example, supermarkets move inventory very quickly, and their stock would likely represent a large portion of their current assets. To strip out inventory for supermarkets would make their current liabilities look inflated, relative to their current assets under the quick ratio. Are the two ratios the higher the better? Not necessarily. An exceptionally high current ratio or quick ratio shows that the company is unable to utilize its assets well. Actually, there is another stricter and even more conservative liquidity ratio, called cash ratio. It indicates a company's capacity to pay off short-term debt obligations, with only its cash and cash equivalents. Although there is no ideal figure, a cash ratio of not lower than 0.5 to 1 is usually preferred. It is important to note that businesses do not ordinarily keep much cash and cash equivalents on the balance sheet, because it is not generating a return for shareholder. So most analysts don't use the cash ratio. When analyzing a company's liquidity condition, no single ratio will suffice in every circumstance. It's important to include other financial ratios in your analysis. So far we have talked about the following topics. In the next video, we will discuss about debt-to-equity ratio. If you have an interest, please click subscribe now to avoid missing it. Thank you for watching, and happy investing.